Hey everyone, welcome back to the channel where we make finance simple and accessible for everyone. Today, we're diving into a true classic, The Intelligent Investor by Benjamin Graham. If you've ever heard of Warren Buffett, this is the book he swears by, and we're going to break it down in a way that's super friendly and easy to understand. This book has been hailed as one of the best books on investing ever written, and the best part is, you don't need a finance degree to understand it. You might think investing is complicated or that you need to have a ton of experience to get started, but that's not true. Graham's approach is all about making smart, long-term decisions and avoiding the common traps of emotional investing that get people into trouble. We'll be covering everything from what it means to be an intelligent investor to key concepts like value investing, the margin of safety, and how to avoid speculation. So, whether you're just starting out or looking to sharpen your skills, you're in the right place. Let's jump into the world of the intelligent investor. Before we dive deep, let's clear one thing up. This book is not about quick fixes, get-rich-quick schemes, or gambling on the stock market. In fact, Benjamin Graham's philosophy is the complete opposite of that. His method is all about patience, discipline, and keeping a cool head, even when the market is chaotic. So, if you're here to learn how to become a smarter, more thoughtful investor, stick around, because we're going to cover all the essentials in a way that's easy to understand. So, what exactly is an intelligent investor? Don't worry, it's not about being a genius or having years of Wall Street experience. According to Graham, an intelligent investor is someone who makes decisions based on logic, facts, and a clear strategy, not on emotions or market hype. It's about having a solid plan and sticking to it, regardless of the noise that surrounds you. Let's use a simple analogy. Imagine you're driving a car. An intelligent driver doesn't speed recklessly down the highway. They stay calm, follow the rules, and avoid risky moves that could cause an accident. Similarly, an intelligent investor doesn't make knee-jerk decisions based on daily market fluctuations. Instead, they focus on long-term goals, avoid emotional reactions, and don't get distracted by short-term noise. The intelligent investor knows that success in investing is not about being the smartest person in the room or predicting every market move. It's about discipline, consistency, and the ability to stay calm, even when everyone else is panicking. Remember, the stock market can often feel like a roller coaster. But if you stay focused on your long-term goals, you can weather the ups and downs. Graham emphasizes that the intelligent investor stays grounded, even when the stock market is bouncing around like crazy. While others are chasing trends or selling off in a panic, the intelligent investor sticks to their strategy. This is the key difference. Intelligent investors don't let their emotions dictate their decisions. They focus on the long term, understanding that the stock market is a tool for building wealth over time, not a casino for short-term gains. So, whether the market is up, down, or sideways, the intelligent investor knows how to stay the course. It's about staying calm, cool, and collected, no matter what's happening around you. This ability to tune out the noise and focus on your long-term plan is what sets successful investors apart from those who lose money in the markets. Now let's talk about one of the most important concepts in the intelligent investor, value investing. Don't worry, it's not as complicated as it sounds. In fact, value investing is actually pretty simple once you understand the basics. At its core, value investing is about finding stocks that are priced lower than their actual worth. Think of it like finding a hidden treasure at a yard sale. You're buying something valuable for less than it's worth and holding on to it until the rest of the world catches on. Here's an example. Imagine you're shopping for a new TV. You know what a good TV is worth. Let's say around $1,000. But you find one on sale for $600. You know it's a quality product, so you grab it because you're getting great value. This is essentially what value investors do with stocks. They look for companies that are temporarily undervalued by the market, buy those stocks, and wait for the market to realize their true worth. But here's where it gets interesting. Value investing requires patience and discipline. It's not about chasing the hottest new stock or trying to time the market perfectly. Instead, it's about doing your research, finding solid companies, and then waiting. The intelligent investor understands that the market doesn't always reflect a company's true value in the short term, but over the long run, value usually wins out. Think of it like planting a tree. You plant the seed today, water it, and give it time to grow. You're not expecting a full-grown tree tomorrow. It's going to take years for it to reach its full potential. But once it's fully grown, it provides shade, fruits, and long-term benefits. That's the essence of value investing, finding opportunities today and letting them grow over time. But how do you know if a stock is undervalued? This is where research comes in. Value investors look at a company's financials, things like earnings, dividends, and long-term potential, to determine whether the current stock price reflects the company's true value. If the stock is priced lower than what you believe it's worth, that's your opportunity to buy. Patience is key. The intelligent investor isn't trying to make a quick profit in the next month or year. Instead, they're playing the long game, confident that their investments will pay off over time. So when others are getting excited about the latest trends or panicking over market dips, the value investor is calmly sticking to their strategy, knowing that long-term growth is what really matters. Next, we're going to talk about one of Benjamin Graham's most famous and important ideas, the margin of safety. This is one of those concepts that can make a huge difference in your investing success. The margin of safety is your financial cushion, your safety net when things don't go as planned. In simple terms, the margin of safety means that you only invest when there's a big enough gap between the stock's current price and its true value. Let's break this down with an example. Say you've done your homework on a company, and you believe its stock is worth $100 per share based on its earnings, future potential, and other financials. But right now, the stock is selling for $60. That $40 difference is your margin of safety. It gives you a buffer in case things don't go exactly as planned. Even if the stock doesn't reach $100, you're still in a good position because you bought it for much less than its true value. Think of it like buying a house. If you know a house is worth $300,000, but you manage to buy it for $200,000, you've got a huge cushion. Even if the market dips a little, you're still in a good position because you didn't overpay. The margin of safety works the same way in investing. It's about making sure you're not paying too much for a stock, so even if things don't go perfectly, you're protected from major losses. This concept is one of the most powerful ways to protect yourself from risk. No matter how confident you are in a company, the stock market can be unpredictable. By building in a margin of safety, you give yourself room to breathe. It's like having airbags in your car. You don't expect to crash, but if something goes wrong, you've got that extra protection. Graham's margin of safety concept is one of the reasons why value investors tend to be more conservative. They're not just looking for stocks that have the potential to go up, they're also making sure that if things go wrong, they won't lose too much. This is why the margin of safety is so important. It's a way of managing risk and ensuring that your portfolio can weather any storm. So remember, the margin of safety is like a seatbelt. You might not need it on every trip, but when the market gets bumpy, it's what keeps you safe. And in investing, having that safety net is what separates successful investors from those who take big risks and end up losing a lot when things don't go according to plan. Now, let's meet one of the most famous characters from The Intelligent Investor, Mr. Market. Mr. Market is a fictional character who represents the stock market. He's a bit like a moody friend. Every day he comes to your door and offers to buy your stocks or sell you more. But here's the thing. Mr. Market's mood swings wildly. Some days he's overly optimistic, offering to buy your stocks at sky-high prices. Other days he's depressed and offers to sell them at bargain prices. The point of Mr. Market is to illustrate how unpredictable the stock market can be. One day prices are soaring and everyone's excited. The next day prices crash and people are panicking. But here's the lesson. You don't have to listen to Mr. Market every day. Just because he offers you a low price doesn't mean your stocks are worth less. And just because he's offering a high price doesn't mean you should rush to sell. Mr. Market's mood swings have nothing to do with the actual value of the companies you've invested in. Think of Mr. Market like a friend who constantly changes their mind. One day, they're ecstatic about everything, and the next, they're down in the dumps. As an intelligent investor, your job is to ignore Mr. Market's mood swings and focus on your long-term goals. You're in control of your investments, not Mr. Market. If he offers you a great deal, like a stock at a bargain price, you can take advantage of it. But if he's in a bad mood and offers you a terrible deal, you can simply walk away. Graham's Mr. Market is a reminder that the stock market is there to serve you, not the other way around. You don't have to react to every offer he makes. Instead, use Mr. Market's mood swings to your advantage. When he's overly pessimistic and offering stocks at a discount, that's when value investors step in. But when he's overly optimistic and driving prices up beyond their true value, that's when smart investors stay calm and stick to their plan. Here's the key takeaway. Mr. Market is there to serve you. You don't need to respond to his daily mood swings. The intelligent investor uses Mr. Market's fluctuations to their advantage, buying when prices are low and ignoring the noise when prices are high. It's all about staying calm, sticking to your strategy, and not letting market emotions dictate your investment decisions. One of the biggest lessons in The Intelligent Investor is understanding the difference between speculation and investing. This is a crucial distinction that many new investors don't fully grasp. Speculation is like gambling. You're betting on short-term price movements and hoping to get lucky. Investing, on the other hand, is about buying assets that will grow in value over time based on solid fundamentals. Let's put it this way. Imagine you're planting a tree. Investing is like nurturing that tree over time, giving it sunlight, water, and care. It's a slow process, but with patience, it grows strong and healthy, bearing fruit year after year. Speculation, on the other hand, is more like buying a lottery ticket. You're hoping for quick, instant riches, but the odds are against you. Most of the time, speculators lose money because they're focused on short-term gains instead of long-term value. Benjamin Graham warns us that speculation can be incredibly dangerous, especially for inexperienced investors. It's easy to get caught up in the excitement of quick profits, but the reality is that most speculators end up losing money in the long run. That's because speculation is based on emotion and guesswork, while investing is based on careful research and a long-term outlook. Think of investing as a marathon, not a sprint. The intelligent investor knows that building wealth takes time, and they're willing to wait for their investments to grow. They're not chasing after the hottest stock or trying to predict what the market will do tomorrow. Instead, they're focused on buying high-quality assets and holding on to them for the long term. Graham makes it clear that speculation isn't always bad. It has its place in the markets. But if you're serious about growing your wealth and protecting your investments, you need to understand the difference between speculation and investing. The key is to make sure that the majority of your portfolio is focused on solid, long-term investments and not on risky bets that could backfire. Finally, let's talk about one of the most important qualities of an intelligent investor: emotional discipline. The stock market can feel like a roller coaster sometimes. Prices go up, prices go down, and it's easy to get caught up in the excitement or fear. But Graham teaches us that the intelligent investor stays calm, no matter what the market is doing. They don't let their emotions drive their decisions. Think of investing like being in a storm at sea. When the waves get rough, some people panic and jump ship. But the intelligent investor stays steady at the helm, knowing that the storm will eventually pass. In the stock market, the same rule applies. Don't let fear or excitement drive your decisions. Stick to your plan, even when the market gets rough, and ride out the waves. One of the biggest mistakes investors make is getting caught up in short-term market movements. When prices go up, it's easy to get greedy and think the good times will last forever. When prices go down, fear takes over, and many investors sell at the worst possible time. But the intelligent investor knows that these emotions, fear and greed, are the enemy of long-term success. Staying calm, having a plan, and sticking to it, that's what makes an intelligent investor. It's not about avoiding risk completely, but about managing risk in a way that allows you to stay the course. Whether the market is soaring or crashing, the intelligent investor stays focused on their long-term goals, knowing that the ups and downs are just part of the journey. Graham teaches us that emotional discipline is one of the most critical traits for any investor. It's easy to get caught up in the excitement when stocks are soaring, and it's just as easy to panic when the market drops. But the intelligent investor knows that the best opportunities often come when others are fearful. They stay patient, knowing that in the long run, calm, disciplined investing will win out. So, what can we learn from the intelligent investor? First, focus on long-term value rather than chasing short-term gains. Always invest with a margin of safety to protect yourself from unexpected losses. And remember, the market's mood swings, personified by Mr. Market, shouldn't dictate your decisions. Instead, use them to your advantage. Stay disciplined, avoid speculation, and keep your emotions in check. Investing might seem complex, but with the right mindset and principles, anyone can become an intelligent investor. So next time you're tempted to react to market swings or chase after the latest trend, remember what you've learned here. Stick to your plan, stay calm, and think long-term. Thanks for watching. If you found this video helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel for more simple, friendly financial advice. See you next time.